Hello everyone and welcome to the QSR Show. This is the show where we get under the hat of all things QSR, and it's a live show where it's live if it's February 26th at 11 a.m. GMT. Now, it's a little different if you are familiar with the franchise show. You will notice that I'm not in my under the stairs Harry Potter-esque office. I'm coming live today from the fantastic Creams Cafe. Now, this is a live show, and because it's live, we love you to join in. We love you to come in, say hello, and get involved in our conversations. So every time we have an episode of the QSR show, we take a new topic and we take a lovely guest. And today is no exception to that. We have a fantastic guest with us. Before I introduce you to him, let's get on to the topic. And the topic today is, why do QSRs make such good franchises? Now, joining us to discuss that is Oliver Rodbard of Creams Cafe. Oliver, welcome to the QSR show.
Good morning, Harvey. Good morning, everybody.
Great to have you with us. So before we get into things today, Oliver, perhaps you could give us a little introduction to yourself, how you've got in the world of franchising, how you got into Creams, and we'll get on then to why you think QSRs make such good franchises.
Yeah, sure, no worries. Well, listen, let me give you the shorthand version rather than the 30-minute monologue. Like a lot of people, I fell into hospitality. It wasn't a career choice at the beginning. I was meant to be an engineer and then had a eureka moment where I realised wearing a white coat and plastic goggles wasn't going to be for me. I got a job in a shop and fell in love with serving customers. So I was actually, the first 10 years of my career were in retail, working for brands like Debenhams, Blockbuster, Game, probably showing my age a little bit now.
I'm showing my age because I've heard of all of those very much.
Yeah, and just very sort of first 10 years, very linear operational roles. So part-timer, full-timer, shift manager, assistant manager, store manager, area manager. I've done all of those types of roles, which I think actually served me well through my career, understanding the experience of our frontline staff and what they go through, dealing with the wonderful general public and all the joys and thrills that brings. And then back in sort of the mid-2000s, I was still in retail. A friend of mine was working for a recruitment consultancy, and he actually said, look, I've got some jobs coming up with Pizza Hut. I haven't got anybody for interview. Would you just do me a favor and go along for interview? So I'm putting some heads in front of them. I thought, well, I'm a retailer. I'm not, I've never really considered food before. It's not really my bag. But you're a good friend. I'll go for the interview. 8 weeks later, I'd handed in my notice in, and I was joining Pizza Hut in the UK. Thinking, well, you know what, they seem like a great company. They're global. The development program's good. Could be a good career step, but I think I'll probably do a couple of years and move back into retail. And here we are 19 years later, and I'm in hospitality and love every moment of it. I spent almost 12 years with Young Brands, the parent company for Pizza Hut. Joined as an area manager, then did a regional director role for the southeast of England. And then I had the opportunity to move into the franchise side of the business, and actually took what's my first office role, running central operations, all the systems and processes that impact the customer, impact our team members in restaurant, or the guest listening programs, etc. So anything that had a process linked to product, safety, customer experience was sort of under the remit of that role. And then I ran the franchise council as well, which was sort of the first foray into working with franchisees. And for those of you that have grown up in equity environments and then moved into the franchising side, you'll know that's a little bit of a shock to start off with. But fell in love with franchising. Really enjoyed the dynamic between the franchisor and the franchisee. I then moved to Paris, and I was actually a franchise business manager for Pizza Hut Europe. So I covered about 15, 16 countries, jetting around everywhere, working with everything from single site operators in the Baltics to the AmRests of the world, and our Portuguese franchisees that are running hundreds of restaurants. So lots of experience in different types of franchise organizations and setups. That then took me to Canada, again, still with Pizza Hut. There's a little bit of KFC along the way in there, but not too much. Where I ran operations, HR and technology for the Canadian market. At around about the 11-year, 12-year point, I think the Kool-Aid had worn off a little bit, and I was just ready for a change. I'd done pizza for a long time. I joined a Canadian business called Freshie, not too well known over here. It had about 500 restaurants across Canada and the US, basically healthy fast food. And again, fully franchised. A couple of equity units that they ran just to play with. Yeah, good product, good company, great brand. COVID hit. Yeah, that was an interesting time, as I'm sure many of you remember that period. And then actually took a decision to move out from the franchisor side, and I joined a British company called Soul Foods Group as their COO based in Canada. Soul Foods run 4 different brands. We've got Taco Bell, KFC, the largest brand they run, Burger King, and Starbucks. So I was a franchisee for 2 years, which was an incredibly interesting experience, having been sat to the other side of the table for most of my career, and to see that dynamic from the other side. Actually probably learned a huge amount about how to be a better franchisor, having been a franchisee.
It's really important to understand the perspectives of both sides when you're doing a job like yours. I think it's really, really important. Look, fantastic introduction. Before we get into today's subject, let's welcome a few people who have joined us here live already today. First of all, we have the fantastic Penny Hopkinson. Penny has put, great to be here, Harvey. It's fantastic to have you with us, Penny. Penny is an author and has a platform that is designed to create your ops manuals without the use of AI. It's an incredible thing. Do check it out. Penny's QR code is on the screen actually right now, if I can find it. There it is. So do check that out. Great to have you with us, Penny. Let us know your thoughts on why QSRs make good franchises. Why are people interested in QSRs? Because in my experience, potential franchisees are always very interested in a QSR business. And we're going to have a bit of a deep delve today as to why QSRs make such good franchises. We've got Simon Wise with us. Great to have you with us, Simon. He's put, hello, franchise friends. It's fantastic to have you with us, Simon. Simon is a recruiter here in the UK for franchise businesses. So it's great to have you with us. And please let us know your thoughts on QSRs and why they make such good franchises. We've got Nick Pletham with us. Nick is from eTalent. Again, someone who's helping us find great people in our franchise businesses. And certainly in the QSR world, good people are really important in the business. You can't run a QSR without good people. He's put, good morning, Harvey and Oliver. We've got a couple more people to welcome before we get into things today, and then we've got a question coming up from Simon. We've got David Moffat here. Always fantastic to have David with us. Huge experience in the world of QSR. So it's going to be great to get your experience, David, on why you think QSRs make good franchise brands. And finally, we've got the lovely Matt Smith. He's put, happy Thursday, both. Great to have you with us, Matt. Spoke to Matt only yesterday. And Matt, of course, understands the world of ice creams, that's for sure. So great to have you with us, Matt. Fantastic. Well, look, before we get to Simon's question, in fact, look, let's get to Simon's question right now, because I like this one. And it's a good place to start, I think. Simon's put, what are the ingredients for a good QSR franchise? And look, that's the essence of what we're talking about today. Why QSRs make such good franchises. Do you think there are ingredients, pardon the pun, I suppose, for QSRs? But what do you think they are? Or why do you think they make such good franchises?
Yeah, well, I think there are some key things that make the franchise model work, and not just in a handful of countries, but globally. I think most importantly, what you have is a repeatable model. And I read an interesting stat the other day that independent restaurants setting up were 8 times less likely to succeed than a franchise restaurant. And you have to sort of, when you get under the skin of what that really means, what is it that a franchise brings, QSR or otherwise.
Yeah.
And I do think at the core is a model that's tried and tested fundamentally, and that it's repeatable. If it's not repeatable, it's going to fail as the brand gets to scale. And I'm sure I've seen some fantastic concepts that get to a certain point, but can't grow beyond that because it's actually not a repeatable model.
Yeah, I think you're right. I mean, obviously that's franchising, that repeatable model. That's at the heart of any franchise business. And I think within QSRs, running your own brand, running your own restaurant is very hard. You've got to come up with all of this stuff and face the battles and fights to make profit and make these businesses successful. It's definitely been in my experience that potential franchisees are excited by QSRs. When you're talking to your new franchisees, what was it that sort of got them excited about the business of ice cream and hospitality and desserts, and what was it that sort of drove their passion, or is that a bit varied over the years?
I think as a prospective franchisee, people have a choice about where they invest their cash. And I think first and foremost, you've got to have a bit of a passion for the brand. When I was working with Soul Food Group, the John Mohammed family were genuinely passionate about the brands that they brought into the business and they were running. And when I'm interviewing and spending time with either new franchisees that are onboarding or certainly at the recruitment stage, do they have a passion for creams? Do they understand what creams is about? I mean, ultimately, you can get a dessert in a number of different places. Creams exist to bring people together. That's our raison d'etre. So if you want to be part of that journey and it excites you that you can create an environment or a place where you bring people together, whether that's a date night or the family or the kids are out, and you see the smile on their face when that gelato gets delivered to the table and, the indulgent treats that we serve, and you like that and you get a buzz off it, then, our brand is the right place for you. So I think there's, as people look at the franchises they go into and which QSR brands or casual dining brands they go into, they've got to feel a bit of passion and connection with the brand and actually enjoy being there as a customer as well. That's as important as the financial decision that gets made, because these are long-term partnerships. These are business partnerships that are going to run for 10 plus years. So it's super important at the beginning. Is it the right brand for you? Is it the right culture? Do you like the people that you're going to be working with? The old adage of hospitality is a people business is just as true today, even with all the technology that we're bringing to the restaurant. It's still at heart a people business and an experiential business.
Yeah, I think that's really interesting. I like what you said there about being a customer first, and I wonder whether that's part of why QSRs are so popular as franchise businesses, because even if you've never heard of franchising before, and even if you're a youngster watching this, right, you've certainly heard of McDonald's or Burger King or Greens or, pretty much every casual dining fast food business you walk through the door. It is franchising is involved. They're franchised. They might, or they might soon be. It's so within the industry, but it's kind of it's not hidden as such, but it's not widely advertised, and you can't necessarily see the difference between a company-owned store and a franchise store, which is a good thing, I suppose.
Which is the way it's meant to be, right?
Yeah.
So it's a consistent experience across all. That's a repeatable system again.
Yeah, that's it. We've got a couple more people that have joined us, and another question coming up. First of all, I'd like to welcome Charles Caldwell to the show. He's calling in from Hong Kong. Always fantastic to have you with us, Charles. He works at a university there in Hong Kong. I'm not sure what the time is there, but I always appreciate you joining us. I know it's probably in the middle of the night, so it's fantastic to have you with us. And we've got a LinkedIn user here that's saying, good morning. Let us know who you are in the body of the message, and we would like to welcome you to the show. Let's have a look at this question here from Simon. Simon has put, government policies are not overly employer or small business friendly, with policies and rising labour costs putting downward pressure on margins for operators in the QSR sector. How have you combated this? Is multi-unit ownership in your network a way forward for franchisees to create economies of scale to combat these pressures? Or maybe they are seeking diversification into other franchise brands too. Look, this is really relevant, And I knew we would get onto this one because there's huge pressure within QSRs. Every person that I talk to, when you talk about something like staffing costs as a percentage of turnover, it sits anywhere between late 20s and late 30s in percentage. So, say that's 35%. And you look at your cost of goods, similar often, right? And you start eating away at this 100%. And, there's not a lot left at the end. So it's a great question. How are you combating that? What sort of things are you trying to do to help the business and help the franchisees get to that end profit?
Right, it's a great question, Simon, and super relevant, right? I speak to other colleagues in the industry and we're all talking about the same stuff at the moment. It's never been harder to run a hospitality business in the UK as it is today. We're working twice as hard just to stand still and to get growth. We're having to work harder than that. So absolutely understand the pressures. I think at Creams we've taken the philosophy that if you have the restaurant P&L at the heart of the decisions that you make, along with the guest experience, you can't detach those two things. You end up building a strategy and a set of tactics around what you're doing with the business that hopefully deliver both. So I think that we have as part of our annual strategy a profit target for our average restaurant P&L, and then build a set of actions around actually we know that minimum wage is going up by X and that's going to deliver 2%, whatever number, to the average restaurant P&L. We know that business rates are going to increase by Y and that's going to hit the P&L. So now we have a cash number that we need to go and find. Now Creams actually have a fairly unique advantage within the QSR casual dining space that we actually manufacture some of our products. So all of our gelato is made in East London, and it's aged overnight. We use the first flowered lemons from the Amalfi Coast for our sorbets, and we're very proud of our product. But what that allows us to do is that we can absorb some of the inflation that we're seeing. We can actually buy the commodities that are making the product. We're not giving that margin away to another manufacturer. And that allows us to protect the P&L to a degree in the way that perhaps some chains that don't manufacture do. We also make our own waffle mix and our own crack mix in our plant in Dunstable, British flour. So we're proud of the provenance there as well. Again, what we've been able to do is move to a Creams manufactured product, and we've been able to keep prices stationary or very small increases versus what we would have had from a vendor. So we've got a little bit of sort of a unique sort of couple of tools in our box that we can bring to our system. And in fact, food service inflation in the last 4 years has been 59.8%. Wow. And we've managed to cap that at 19.6. Oh, wow. We're super proud of that. And I think that, but that only happens because the average store P&L is at the heart of the decision making. And if it wasn't, we would get distracted by all the other stuff. Because it's not that anybody's not busy at the moment. And I know, the other brands, our competitors, other people in the space are facing exactly the same challenges.
Everyone is. I think you've really hit upon something here that's so important in the industry. And we're talking today about why QSRs make such good franchises. And they still make good franchises, even though there's huge pressures on QSRs to hit that bottom line profitability and ultimately get a return on an investment for a potential franchisee. But having the P&L at the heart of it, as a franchisor understanding that P&L, and as a franchisee understanding that P&L. I think I had a conversation on our sister show, on the Franchise Show, just last week about people not understanding their numbers. Right? And if you don't understand your numbers, if you shy away from discovering what your net profit is, what your gross profit is, what your EBITDA is, and not knowing the difference between those, you can come across some very nasty, unexpected things in the future, can't you? So having that P&L at the heart of your business, making sure you talk to franchisees, making sure they understand it, and that you're all aware of what it is. I love that.
Simon made a good, as part of his first question, I think, talked about, do you navigate the current climate through a single site operation or a multi-site operation? And actually do you spread risk by having more units? I'm assuming he was implying that, Simon, you were implying that because the margins are lower, you can actually generate more EBITDA, more cash by having more units. And absolutely, that is one method that you can use to do it. But I think, though, if you lose sight of the one store economics, then you have a problem. Now, I think the way I would approach that would be a little bit different in terms of the answer to your question would be, is this site an owner-operator site because of the volume and therefore the profitability level it's going to generate? And the unit economics for a multi-site player are different. They have overheads to cover that an owner-operator won't have. So we tend to look at it as, we believe this site will generate X sales, therefore it's suitable for a multi-site operator. And if it doesn't generate that level, it's ideal for an owner-operator.
I see, because that owner, you can take an element of the staffing costs and incorporate that into the P&L in a different way.
Yeah,
I get that. And look, I think it's really interesting because, again, economies of scale, maybe, but like you say, unit economics on each site is still important as you grow to multi-site. Because if you have 10 sites that on their own aren't profitable, they won't necessarily be profitable when you collect them together. They're still individual businesses running. So I think even as you grow as a multi-site owner, each one of those sites that you look at, you have to look at that as an independent site operating and being profitable as a site. Then you add them together and you might get some economics, and some, you might really get some benefits from going it that way. But look, this is a great question. And it's a two. Just give me one sec. Our internet just dropped out for a moment. Just give me 1 second. And we're back. What we were saying there is about unit economics, and it's really important. Now, the other side of Simon's question here was on diversification, and I think this is an interesting point. And in fact, Oliver and I were touching on this when we had a conversation before we went live today. And when you've got a business like Creed, everyone knows what's going to happen when you come in, right? It's something that you're going to get a lovely sweet treat. That's your business. Often that's a business that happens later in the day, and an evening offer. Have you been looking at sort of new day parts? Have you been looking at ways to sort of stretch and extend that offer and offer that diversification?
Yeah, absolutely. We brought in a new leadership team around about 2.5 years ago. As the business is evolving, and one of the things we've been doing is looking at building new platforms to sweat the assets 24 hours a day, essentially. Rent doesn't stop being paid at breakfast time yet. Cream doesn't have a breakfast offer today. But if we were to go all in from dessert to breakfast, I think the gap's too big. So what we've done is we've first of all gone out and developed a really credible coffee offer. So now we're able to play in different day parts because we've got a really good coffee partnership with Grumpy Mule. I'm a coffee addict, and a really good platform there that can bring people in with savouries in the morning, which is sort of more of a breakfast platform, cakes mid-afternoon, etc. Our lunchtime offers, we've actually taken our sweet crepes, and we've now built a crepe pocket, and we have savoury fillings with the crepe pocket. That's designed specifically for lunchtime and early evening. And we've just launched a product called Truffle Toast, which is French toast but cooked in a waffle iron and then topped. And we've got some fantastic savoury versions of that that's really good for brunch. And I think that when you now go through and have a look at perhaps 10 or 15 years ago, a dessert chain could be pretty quiet during the day and then be really busy late afternoon, early evening until midnight, and that would be good enough. It's not anymore, which is why the new platforms are there to get sales and customers in and add relevant products to the brand as well. If you go off brand, then people don't connect with it. So that's sort of some of the work that's been going on at Cream.
Yeah, I think that's very important when you're looking at diversification, right? You can't go too far off the brand. It's got to have a connection back to the values, a connection back to the core, to the reason people come in, and if you're sensitive, like you say, you've got some crepes there, some waffles, they're all taking elements of the menu. And this is not just to be sensitive to the brand and to make sure that when people come in, they're familiar with things when you're interested and they trust a new offer. But also, of course, you're using SKUs that are already within
Exactly.
the menu. You're using products, and that's going to help the business. That's going to help
and operational processes, right? So if people are used to following certain process to make a product, well, you can leverage that to increase the different number of platforms and the products that you offer. You already have the muscle memory built in with the team members, because ultimately it's not me that's going to be making a frothful toast at 7 p.m. on a Friday. I will do, and I have done, but I'm very slow, even though it will taste great. But actually, it's the team members that are making it in 3 minutes, and I have to knock that product out in a great quality. So you've always got to consider, if you bring a new platform in, is it executable? And again, it comes back to that repeatable model piece. Can every store do it, and can you do it to the same quality?
Yeah, absolutely. Let's welcome a few more people. We've got some good comments coming in from Matt, from David Sweeney. But let's welcome a few people first. So we've got Tom Allen here. That may be the comedian, I'm not sure. But anyway, Tom, no, it's great to have you with us. And Tom's put good morning. We've got David Sweeney with us as well, from Dojo Brands, and a coffee brand as well. David has put, let's have a look at this one. How do you ensure that a new franchisee has sufficient reserves of capital to resolve, to support the business until it can stand on its own? Look, I think it's really interesting. Again, I'm going to take this back to why QSRs make good franchises. And we're talking a lot about the challenges in a QSR, okay? But I think at its core, people enjoy QSR. They enjoy hospitality, right? If it's, let's say if it's a care franchise or a pet franchise, that normally comes from you're passionate about animals, or you've had a relative that's had to be looked after, and you've just got this real burning passion about it. But hospitality touches our lives on a daily basis, and it always, I don't know, it's filled with great memories. Going out for a meal, for an ice cream, for a drink, whatever it might be. It's always associated with time with friends. So I think everyone is drawn to these businesses, and if you think, I can be immersed in that. I remember when I was working for Coffee Republic, and I used to speak to franchisees, and I used to say, what do you picture in your mind when you're in the business? And I remember one of them just describing to me the shop, the smell of the coffee, the sun coming through a window. And I think it was so vivid for them. They really could see it. And I think that's one of the reasons that, despite the challenges that we're talking about today, which are really real and really important, I think that's where this passion, where this interest in QSR is coming from, because we're all touched by it on a daily basis. But look, let's have a look at this. And we've also got a good question coming up from Nick Plevin as well. So we're going to come to that in a minute. But let's look at this one again. So how do you ensure that a new franchisee has sufficient reserves of capital to support the business, during that early stage? I guess it's good due diligence on your part, on their part, great transparency, good understanding of what that P&L, and you mentioned that at the beginning, and I suppose it's still that focus on that P&L. What do you make of this one?
I think this is around, you mentioned due diligence there. When I think about the recruitment and onboarding process for a new franchisee, it's the responsibility of the brand to make sure that the new partner has the right amount of capital to launch the business. We all know that there's investment required in the first few months. You've got additional training, which you probably won't do normally. You've got your startup cost. You've got marketing that you want to do to establish the brand in that trade zone. That will be over and above sort of your normal ongoing spend. So there are quite a few costs that hit that first year. And part of our assessment when we're meeting new franchisees is not just, do you like the brand? Are we going to work well together? Are we a good cultural fit? But actually, do you understand how to operate a food and beverage business? And if not, that then tailors your onboarding process. You might have run retail. My background's retail. I came into food. I did a really good job with the customer service, the selling, all that kind of stuff. I was awful at the food safety bit and understanding all of the really important stuff that keeps customers safe. I had to learn that and develop that skill set. So you need to find that out during your interview process. So there's nothing to be hidden on the way in for either partner. And I think a part of that is the financial piece as well. So what capital do they have access to? The worst decision a brand could make is to bring in a new franchisee because they're desperate to open more new units, knowing that if there's a bump in the road, they're not going to have the capital or the access to cash. You're doing them a huge disservice. Again, it kind of comes back down to me it's a 10-year plus business partnership. You've got to get it right at the get-go. And that's not just the relationship piece, it's the financial piece as well.
You're absolutely right. You're absolutely right. We've got some great questions coming up, which is going to take our conversation down some interesting roads, I think. So we're going to get to those in a moment. But if you have just joined us today, this is the QSR Show. And today we are talking about why QSRs make such good franchise businesses. And we've been joined by Oliver Rodbard of Creams to talk about this. It's been a great conversation so far. Please do click the replay if you've only just joined us. And if you are still with us, please keep putting in your questions. We've got some great questions coming up, which we'll get to right now. So let's have a look. I'm going to go to this one by Nick Plevan, actually. We've got some great comments coming up from Simon as well. Nick has put, how much of a problem is staff recruitment for a QSR when a team member leaves unexpectedly? Do most QSRs have a clear recruitment process in place? Now, I really like this one because we've touched a little bit about on the cost of goods, and you mentioned there about manufacturing and some of the ways you can negate some of these price increases and help your business and your franchisees. But another big element of hospitality is, of course, staff. And not just cost of staff, but making sure staff are nurtured, well looked after, happy in their business, in their job. You know, what's your sort of take on staff? You know, where are the challenges for you?
I think an observation I'll share first, if I may, is the very best franchisees I've had the privilege of either working alongside or working in the brands that I've been on the franchisor side have created a family-like environment or culture within their business. So they've not only brought to life the brand values, but their personal and family values as well. And when you think about the restaurants that you've been into as a customer, where the service is rocking, the staff are having fun, and you can feel that. It's because the GM or the owner have created that in the store. So it's the culture in the restaurant that you can feel, and that brings that service model to life. So and I think that plays really into retention as well. So if you've got the owner of the business, the GM in the business, actually creating that culture, one, retention, you know, increases and turnover drops. But we're in a high turnover industry. So I think sort of training people well and onboarding them, the failure rate in the first 12 weeks when it's high, it's almost always linked to the onboarding experience. You know, were they recruited, were they told what the job would be, were they told the horrible bits of the job, like cleaning the toilets and the mopping the floor and that kind of stuff. And, you know, do people come into that job eyes wide open, expecting, you know, what they saw is what they expected? Is it a fun environment to work in? And then actually always being on with recruitment. Almost all brands provide recruitment tools, guidelines, interview guides, etc., and use them because they've been based in science, they've been based on experience, and they generally work. And they'll get the right person for the brand that you're running.
I think that's really interesting. When you talk about sort of culture and that right person, you know, when you try and find somebody for the business, are you looking for the right sort of skills and experience? Are you looking for the right soft skills, the right person? You know, are they the right fit for the business? Because I think it's in my experience that longevity and the right person for the job comes not from a list of skills and experience. It comes from the right person for the culture, that they're a real fit. You've said there about that family culture. Is that in your experience, you get a better result if you concentrate on that side of things?
To the age-old adage of, you know, hire for personality and develop skills. Passionately believe in it. If somebody rocks up and they've got the right approach to life, they're a nice person, they've got some evidence, or you get the belief that they'll work hard, everything else can be taught. You know, I wasn't born knowing how to be a COO. It's learned the hard way. And I think that you get the right attitude into the business, and they fit the team that you're running. And, you know, the personality mix within there as well. And that's where you get good retention and great performance from as well.
Absolutely. And we've got some great questions coming up from David Sweeney, from Matt Smith, from Simon Wise, and from Tom Oliver. We've got about 10 minutes or so left. So we're going to try and get to some of these. So let's have a look at David Sweeney's question here. David's put, how long should the ROI be in a QSR franchise? This is a great question, actually, because look, I've been in the world of QSRs for many years, and in franchising for a few years as well. And look, a return on investment is one of the questions that every single franchisee will and should ask as well. You know, you're investing in most cases quite a considerable sum of money, and you're going to want to know in how many years that might come in. You know, without giving huge amounts of detail on this, because I know it's going to vary. It's going to vary on site, and how they run the business. But I've heard it anywhere between 18 months and 8 to 10 years. What's your take on where that return on investment should sit in terms of time?
Yeah, look, you're absolutely right. There's a number of different factors that play into this. We could probably do an entire show about ROI.
Yeah, I'm going to write that one down. It's a good idea. ROI. Yeah.
And I think it does depend on the brand and all your build costs and setup costs as well. Look, we think a sweet spot is about 2.5 to 3 years for creams. 3 years is a number I hear bandied around quite commonly between lots of the different brands I've worked for or with. But very much depends on the format. If you're building a KFC drive-through, versus a Subway, there's a materially different amount of money needed.
Yeah, absolutely. You know, and I was speaking to a few of the big US brands where the build is 7 figures, right? And the return on investment is longer because you've got a lot of investment you're putting in there to get back. But you know, the potential profitability, the revenue per year, all of these things are higher as well.
Yeah. And some of it a little bit comes back down to that. Are you a multi-site operator? Do you have a high propensity to risk? Yeah. Because you can afford to take some risk because you already have 10 sites that are generating a good amount of cash. Or you're a single site investor, therefore your risk propensity is going to be lower because it has to work for you. I think that changes. We have sites that have got a 12 to 18 month payback. And we have sites that have a little bit longer than that as well. So I think it really does depend on a ton of different factors.
Absolutely. Great question though, David. Thanks very much for that question. Let's have a look at Matt's question here. Matt's put, in the current UK QSR landscape, how can franchisors strike the right balance between enforcing brand standards at site level and allowing franchise partners enough commercial flexibility to protect EBITDA in the face of rising labour, food and occupancy costs? I think this is a really interesting one, right? And thanks so much, Matt, for your question. Definitely in my experience, franchisors, not because they don't want to follow the playbook or the processes that are in a franchise brand, but because they are looking for ways to diversify, to make more EBITDA, or to make more profit, or to protect their business. And therefore they try and buy something cheaper, or they try and add something that shouldn't be on the menu onto the menu. For me, it's just as you said, you know, you're doing that manufacturing piece to try and protect some of that so that franchisees don't feel they need to go out and buy, not that they can, but they don't need to go out and buy gelato from somewhere else because you're giving the best product at the best price, or that's what you're trying to do. But how do you sort of negate that risk and find that balance of allowing franchisees to innovate, give you ideas into the business whilst following brand standards?
Yeah, it's a really good question, and I think I've faced this one in every single brand I've worked with. I think the key to this is actually coming back to the point that it's a business partnership with your franchisees. Therefore, you should be innovating together. So the franchisees that I've worked with have never been slow at coming forward around it when there's a problem. So actually having that dialogue that we're trying to solve some stuff, or we need you as the franchisor to help us solve this, and then working together. If you go off and do it independently, and you know, franchisee A comes up with a solution, brand B comes up with their solution, they're completely different. Everybody's working hard and actually not together. So we've created franchise sort of listening forums. We have franchise groups that come together and sort of raise issues or challenges for the brand. And then we put that into a priority stream, and then we go and say, okay, well, actually, we know that we've got to deal with the April minimum wage increase. How are we going to do that? Well, we've got this play on efficiency, we've got this pricing test in play, etc. So actually, we tackle it together. You're going to be part of the testing. And actually, a lot of the best ideas come out of the restaurants. whether that's a team member, a GM, or the franchise owner. You think about some of the hero products that we all know about, from the Big Mac to the Whopper to the Zinger Burger. Some of our shakes have been created by franchisees. And they don't just think about product, they think about process and efficiency too. So actually having the processes in your brand and your business to listen and then act, I think is probably the most important part.
I think you've absolutely nailed this here. It's so important. You said there about listening. It's so important that a franchisee is listened to. If they've got a great idea, that there's got to be a process in your brand for that idea to be heard, right? Because like you said, some of the best ideas in hospitality have come from franchisees or members of staff, people working day to day in the business, and it's not unexpected actually that a great idea is going to come from someone who is regularly doing the same thing, over and over again, because they're going to find better ways to do it. And so, I love that. It's a great question, and it's a great point for people to consider. Franchisors, franchisees, if you're a franchisee, ask that question. Is there a process in place for us to innovate and give ideas? Because it could be a frustration moving forward if there's not, or if that process is not robust enough. Great, love that question. We've got questions coming up from Tom Allen, another one from Simon. I'm going to put this comment up from Simon as well. Simon's put, didn't know you did coffee. I know where to get my coffee fix now, so that's good. Simon's now a customer of yours, so that's good stuff.
Love it.
Fantastic. I'm going to definitely get to Tom's question, but let's just quickly put up Simon's. Now, this is a great one because, again, I think this is a really relevant conversation. In fact, it's going to be another episode of this, but let's touch on it today. Can you talk about location finding leases in the current climate? Are there any challenges that you as a QSR franchise brand are supporting with? Again, it can be a whole episode about finding the right location, and it will be as well. But let's touch on it, because we're talking about today why QSRs make good franchise businesses. And you get a lot of franchisees that you can operate from home, right? But a QSR business, 9 times out of 10, it's a bricks and mortar, whether that's a kiosk, a drive-through, or a fantastic location like this one. So what's that sort of process? Do you find a property, try and hold it, and then find a good franchisee? Or do you find a good franchisee and try and work with them to find a good property?
Yeah.
So really,
it's a good question, and actually both of those work. So we typically will recruit. We have target areas that we'd like to open new cream cafes in. We will recruit in those areas, but we also get organic queries as well, where people come to us and say, I live here and I'd like to build a business in this geographical area. We use external acquisitions brokers when we sort of narrowed in on where we want to be to actually find sites for us. But before that starts, we did quite a bit of work with sort of demographics, local spending power, A/B mix, all this sort of stuff where we know, is it a creams customer? We know we index really well with families and with young adults. So if everybody in the town is a retiree, could we do a good business there? Quite possibly. But if there were more families, we'd know it'd be even healthier. So we'll go and do a lot of the scientific research around the trade zone and spending power. Then we'll use brokers to find real estate for us. One thing I have noticed is that finding sites is a skill set in itself. There are people that are very good at doing it. That's not always within the franchisee skill set, and it's the area that we found that we needed to provide more help to our franchisees. And it's not that some of our franchisees don't find good sites; they do. The other piece that comes into this is local knowledge. So you can do all of the numbers on a piece of paper that you like. And sometimes you just need the franchisee who knows the footfall, that knows the stream of traffic, which direction people walk back. 20 meters on a high street can be the difference between failing or succeeding in a site. And sometimes that local knowledge is absolutely critical.
Yeah, I think you're absolutely right. Knowing the local area is really important. You can use fantastic mapping software and demographic software that can help you identify, traveling distance to a location, who is living within that area, who's traveling through it. But something like a creams business is a destination venue, right? It's not necessarily relying on people walking past, right? It's who's in the area, and there's a draw to the location. Do you find that, or do you do footfall counts as well?
I mean, we do them as well. What we know about our brand is we're destination.
Yes,
so people
exactly.
basically go, you know what, I'm going to treat myself today. I'm going to go and have a
going
dessert,
to,
or I'm going to go and have my meal at Nando's, and I'm going to come to Creams for my dessert after,
Exactly.
whatever that what is. So people have already made a decision. So we tend to find that the sites that work best for us, and we have this in our sort of search philosophy, is where can people get to? Are we accessible? Is there parking? Is it free? How close is it to other food vendors, etc. So we have all these success criteria that we plumb into the model, and then we use the local knowledge of the franchisee as well.
Yeah, I love it. If you have just joined us today, this is the QSR Show. Today we are talking about why QSRs make fantastic franchise businesses. And we've been joined by Oliver Rodbard of Creams Cafe. It's been a fantastic conversation so far. We are starting to come to the end of our conversation today, but please pop in a comment if you're here. We will also be able to answer those after the show today as well. So the conversation continues. Look, we're going to probably end on this last comment here from Tom Allen. And Tom's put, Oliver, from your experience on both sides of the franchise table, how have you dealt with operational consistency in varied portfolios? I really like this question. We touched a little bit on multi-site, i.e. someone getting more than one Creams Cafe. But this is now somebody who, let's say, operates 6 different brands, right? And it must be a challenge, or I know it is a challenge. If you're operating six different brands with 6 different operational procedures, there's elements of all of those businesses that start, coming across in a natural way. So how do you, if you've got somebody who's got some coffee shops or some burger shops and some dessert parlors, is that a challenge you've come across, or do you think people just really understand it and they just get it?
Yeah, I think it in part depends on the complexity of the business. Running a KFC, there's a lot more process in that business than running a Subway, as an example. Therefore, if you've got both of those brands in your portfolio, is it simple to move people backwards and forwards? If you see seasonal trends, KFC might get busier, Subway might get quieter. It may not be that easy. So I think it depends on the brands in the portfolio. It depends on the expertise that you need. I think the best example I've ever seen of this is actually in Cyprus. I used to work with a franchise organisation there that are multi-brand, and they got to a big enough scale where they could have a brand leader for each of the brands. So somebody got up every single morning and all they did was think about Pizza Hut. Somebody gets up every morning, all they did was think about Wagamama's. The other person got up and all they thought about was KFC. Now, within the wider business, did they move talent around between brands? Absolutely, and it was planned, and they took people on that journey. But somebody who makes a wonderful KFC manager, who's extraordinarily good under pressure and process and high volume, might not be the right person to lead a Creams Cafe, which is all about the wow and the service and the connection. It's a little bit more of a dining experience. So you need to have the right person. So very possible, and there's lots of people that do a really good job with it, but it's not easy. And again, it comes back down to the people, I think.
Yeah, I think you're absolutely right. And look, great question, Tom. We are now coming to the end of today's episode. Before we sort of round things up, Oliver, perhaps you could just sort of give us your final thoughts after our conversation today about why you feel QSRs are making good franchises, where we should perhaps go in the future, and a few sort of final words from you.
Yeah, sure. Look, I think there are a number of reasons that QSRs have been proven to be good franchise businesses. Repeatable operations, so good process and steps to be able to execute that process repeatably. Strong unit economics, which make it worthwhile for the franchisees to build more restaurants. Supply chain, so that is whether the brand manufactures or just procures on your behalf. There's a heck of a lot of work that goes into that. Real estate flexibility, so the ability to help franchisees find the right locations and increase the chance of being successful. And then technology, which we haven't talked about at all today. But actually, when you think about the technology platforms that brands bring in, Creams have just launched a brand new customer ordering app that actually allows customers to order and pay from table, click and collect, but really critically, order for delivery. And that actually saves our franchisees 20 points of aggregator commission, actually 25 points of aggregator commission when they order through the Creams app. So it's better for the customer, they pay less. It's better for the franchisee because they take more margin home. So brands can bring that tech platform in, which is so difficult to do as a small operator because you need that expertise and know-how. So I think that's, again, probably a great topic for an entire show.
It really is.
But,
you're absolutely right.
Yeah.
And that's an incredible thing you just said there, saving that percentage there on that delivery model. The aggregator platforms tend to unfortunately take quite a bit of that margin. I know they've got their cost to cover, but what a great idea, what a great way to negate some of those costs by bringing your own app. I suppose perhaps we could finish with this, actually, because this is a nice way to finish. What's the future looking like for Creams? What exciting things have you got to come in the coming sort of weeks?
Yes, we've got some really, really cool stuff about to happen in 2026. So we are close to engaging on a new partnership in the leisure space. Because leisure and desserts go really well together, particularly gelato. So more to follow on that. We are expanding internationally over the course of the next 12 months as well. And the key for us is that we're not losing focus on the domestic market. All of that's not going to detract us from growing in the UK. We're actively recruiting for new franchisees. We've got target trade zones. And, I think we've spent the last couple of years as a new leadership team putting foundations into the business. I mean, we're now ready to hit, put our foot on the gas and grow, rapidly. So we're excited about the year that lies ahead. There's a lot of work, but a lot of fun stuff going on. And even in a typical trading environment, we're really upbeat about what the future's going to look like.
Fantastic. Have you got any plans to sort of any international type expansion, anything like that?
Yep, there's a couple of countries that we're working on at the moment that we hope to go into over the course of 2026. Again, when the ink dries on the contract, we'll have more to share, but we're pretty close to that and excited about taking Creams to new markets as well.
Love it. Love it. Fantastic. Well, look, we have now come to the end of today's episode. So I first of all want to thank everyone who has joined us live here today. You really are what makes this show special. Genuinely, when we start this, I have 0 written down. And the reason is because you all come in with amazing questions, with amazing insights into our fantastic QSR world. So I want to thank everyone who has been here and taking your time out this morning to join in with the conversation. And of course, I'd like to thank Oliver for taking his time and sharing his insights. It's fantastic to have you on the QSR show, and thank you so much for being here. Fantastic. Right, well, that's it from us. And until next time, we will be live from another fantastic QSR location next month at some point, date to be confirmed. Let's finish by a couple of comments. Matt Smith has come in with awesome show. Could listen to you both all day. Well, thanks so much, Matt. That's very kind of you. And Tom Allen has come back with thanks, gents. Well, you're very welcome. Oh, and David Sweeney's come in with well done, Harvey, and thank you. Well, look, it's been great to have you all with us. And until next time, take very good care. Cheerio.